Welcome back to our channel. Before we dive in, remember that the content provided in this video is for informational purposes only and not financial advice. Today, we're delving into the intriguing world of investments, specifically the major contrasts between stocks and cryptocurrencies. From market maturity to trading hours, these two investment vehicles are vastly different. So whether you're a seasoned investor or a newbie, understanding these contrasts could help you make informed decisions. First, let's clarify what we mean by stocks and cryptocurrencies. Stocks, simply put, are shares in a company. When you buy a stock, you're purchasing a piece of that company, becoming a part owner. You're investing in the company's future, banking on its success. On the other hand, cryptocurrencies are digital or virtual currencies that use cryptography for security. Bitcoin, the first and most well-known cryptocurrency, was created in 2009 as a decentralized form of currency, independent from any government or institution. Unlike stocks, when you buy a cryptocurrency, you're not buying a stake in a company. Instead, you're buying a digital asset that can be used in various ways, depending on the cryptocurrency. Now that we have a basic understanding of both, let's delve into their contrasts. The first major contrast lies in the concept of ownership. When you invest in stocks, you're essentially buying a piece of a company. It's like owning a slice of a giant corporate pie. You have a direct claim on its assets and earnings, which can translate into dividends or capital gains as the company grows and prospers. On the other hand, cryptocurrencies are a whole different ballgame. When you purchase a cryptocurrency, you're not buying a stake in a corporation. Instead, you're acquiring a digital asset, a unique line of code, if you will. This code, stored in a digital wallet, represents a certain value based on supply and demand dynamics in the crypto market. To put it simply, owning stocks means you're part of a company's financial journey, sharing in its successes and failures. But with cryptocurrencies, you hold a digital asset that dances to the tune of market forces. So, in stocks you own a piece of a company, in cryptocurrencies, you own a line of code. Our second contrast is about regulation. Stocks are heavily regulated by government bodies around the world. In the United States, for example, the Securities and Exchange Commission oversees the stock market to ensure fairness and transparency. They have the power to enforce laws, investigate potential fraud, and protect investors. On the other hand, cryptocurrencies operate in a largely unregulated space. There's no central authority that governs or controls the crypto market. This opens the door for innovation and flexibility, but it also brings a higher degree of risk. Cryptocurrencies can be subjected to wild price swings, and investors might face potential losses if a cryptocurrency project turns out to be a scam or fails. This stark difference in regulation is a crucial aspect to consider when comparing stocks and cryptocurrencies. It's not just about potential returns, it's also about understanding the level of risk you're comfortable with. This difference in regulation is a key factor in the risk profiles of stocks and cryptocurrencies. The third difference is the market maturity. Now, when we talk about the stock market, it's like referring to a well-aged wine. It has been around for centuries, with its roots tracing back to the 17th century. Its maturity is reflected in its stability and the regulatory frameworks that govern it. On the other hand, the cryptocurrency market is like a zesty, exciting cocktail, still in its early days. Born in the digital era, it has been around for just a little over a decade. It's still in its infancy, developing and evolving rapidly. This young age is both its strength and its weakness. It allows for innovation and growth, but it also means it's susceptible to dramatic swings and unpredictability. So, while the stock market is a steady ship sailing in a well-charted sea, the cryptocurrency market is more like a speedboat zipping across uncharted waters. This means that the cryptocurrency market can be significantly more volatile. The fourth contrast is in trading hours. Now, any seasoned stock trader will tell you that traditional stock markets operate on business hours. This typically means a 5-day week, from Monday to Friday, and around 6 to 7 hours per day. Also, don't forget about holidays. There's no trading on Christmas or New Year's Day, but when we talk about cryptocurrencies, it's a whole different ballgame. Cryptocurrency markets are like the city that never sleeps. They function 24 hours a day, 7 days a week, and yes, 365 days a year. There are no weekends, no holidays, and certainly no closing bells. What does this mean for you as an investor? Well, it means that the cryptocurrency market is constantly moving. Prices can change dramatically while you're sleeping or even during your lunch break. This round-the-clock trading can lead to more price changes for cryptocurrencies. Fifth on our list is dividends. Now, if you're not familiar, dividends are a portion of a company's earnings that are distributed to shareholders. It's a way for companies to share their success with the people who have invested in them. This can be a significant benefit of owning stocks. You're not just hoping for the stock's value to rise, you're also potentially earning money from dividends. Cryptocurrencies, on the other hand, don't offer dividends. When you invest in a cryptocurrency, your potential for profit lies entirely in the coin's value increasing. You're not going to receive a share of Bitcoin's earnings because, well, Bitcoin doesn't have earnings. It's not a company, it's a currency. This difference can have a big impact on your investment strategy. If you're looking for a steady passive income, stocks might be more your speed. But if you're comfortable with a bit more risk and potential for high reward, cryptocurrencies might be more appealing. This means stocks can provide an additional form of income that cryptocurrencies don't. The sixth contrast is transparency. In the world of investing, transparency is key. It's about having a clear, unobstructed view into the inner workings of companies and markets. The stock market, by design, offers a high level of transparency. Companies that are publicly traded are required by law to disclose pertinent information, such as financial statements and business operations. This allows investors to make well-informed decisions. On the flip side, the cryptocurrency market operates with a different level of transparency. While the blockchain technology that underpins cryptocurrencies is transparent in terms of transaction history, the overall market lacks the same level of clarity. Factors such as the anonymous nature of transactions, the lack of regulatory oversight, and the absence of mandatory disclosures can make it difficult for investors to fully understand the risks involved. This lack of transparency can make cryptocurrencies a riskier investment. The seventh contrast is inaccessibility. Let's dive into it. Stocks and cryptocurrencies operate in different realms when it comes to how they can be accessed. When you want to buy stocks, you need to go through a brokerage. This is like a middleman that handles transactions between buyers and sellers. It's a system that's been in place for decades. Now let's flip the coin to cryptocurrencies. They offer a stark contrast. With digital currencies, you can buy them directly, without the need for a broker. You simply need a digital wallet, which is readily available. And you can buy cryptocurrencies from an exchange or even from another person. This direct approach has a significant impact. It eliminates the need for a middleman and reduces the barriers to entry. The simplicity and ease of this process make cryptocurrencies potentially more accessible to the average person. So that's another factor to consider when comparing stocks and cryptocurrencies. The eighth contrast is volatility. Now let's dive into this realm of unpredictability and rapid changes. Stocks have their ups and downs, sure, but when you compare them to cryptocurrencies, they're like a boat gently bobbing on a lake versus a raft in the middle of a stormy sea. Cryptocurrencies are known for their wild price swings. One day, you're on top of the world. The next, you're digging deep into the trenches. This is largely due to the fact that the crypto market is still in its infancy and is more susceptible to market sentiment and speculative trading. On the flip side, this dramatic volatility can be a magnet for risk-tolerant investors seeking high returns. But remember, where there's potential for high reward, there's also potential for high risk. Cryptocurrency's volatility is a double-edged sword. It can carve out opportunities for significant profits, but it can also cut deep with substantial losses. This higher volatility can lead to bigger gains, but also bigger losses. Always proceed with caution and do your due diligence. The ninth contrast is in use cases. Stocks, as most of us know, are primarily for investment. When you buy a stock, you're buying a piece of a company, betting on its future success. It's quite straightforward, isn't it? But when you step into the realm of cryptocurrencies, things get a bit more diverse. Cryptocurrencies are not just a speculative asset, they serve a multitude of other functions. They can be a medium of exchange, a unit of account, or even a store of value. Some cryptocurrencies, like Ethereum, even allow for the creation of smart contracts and decentralized applications. And let's not forget about Bitcoin, which was created as a digital alternative to traditional currencies, aiming to be a global peer-to-peer payment system. This wide array of use cases not only makes cryptocurrencies versatile, it also opens up a world of possibilities for future growth and development. This gives cryptocurrencies a potential advantage in terms of future growth. The 10th and final contrast is storage. When it comes to stocks, you'll typically find them residing snugly within a brokerage account. It's a familiar environment, it's secure, and it's easy to manage. On the flip side, cryptocurrencies require something a bit different: a digital wallet. Now this might sound techy, and honestly it is. Cryptocurrencies, with their digital nature, need a digital home. This means that the storage of cryptocurrencies can be more complex. We've covered a lot today, but remember that investing always comes with risks. We've explored the contrast between stocks and cryptocurrencies, touching on aspects like ownership, regulation, market maturity, trading hours, dividends, transparency, accessibility, volatility, use cases, and storage. Each has its unique features and potential pitfalls. It's crucial to do your own research and understand your investment choices thoroughly. Thanks for watching. Be sure to like, comment, and subscribe.